Hello, Sense of Things audience. It's Jeff and Ron here once again for another weekly update on what's going on in the world. Ron, how you doing, bud?
Good morning, Jeff. Hey, never a dull moment, right? Always economic news, always geopolitical news.
Good Lord. And this week was full of it, all kinds of places all over the place. Can't wait to get started on that. And I wanted to start us off with a pop culture
Please.
reference
Yes, I'm excited.
because this one just made me chuckle this morning and I just had to share it with the audience. So I shall start with just the beginnings of this.
What?
No, this is Norfolk in Nebraska. This is Lee. I forget what his last name is, and his Watusi bull, Howdy Doody.
Wait, that's a real live bull?
Oh yes, this is a real live
Oh
bull.
my God, look at the size of those horns. That's not holy.
No, it's not a stuffed animal. This is an actual bull. So yeah, I wanted to share this a little bit so you can see it.
Oh my God. Wait, no, that car looks like it's designed for a bull.
It is. It's specifically designed.
What's the matter? Did they get a ticket for not wearing a seatbelt?
No, they said that there were some violations. Now you'll see the violations to the former police car here in just a minute.
Wait, how did he even get the bull to go in there?
He's in there. He's got a special spot along the side.
Yeah, but how did he get him in there? I understand he's there, but
oh
my God. Obviously, he didn't have him wearing a diaper.
Yep, no, there's plenty of violations. So Lee actually uses this car for parades and stuff like that. And so he won the best car for this rodeo parade. But I just wanted to share the crack police department here in Nebraska. The guy is I guess their spokesman or whatever, and it says, yeah, what does it say? We didn't have a full understanding of what it was because they were getting all these calls from 911 from people going that this bull was riding shotgun in the car. He says, it wouldn't go far without being noticed for sure. Yeah, you think? There's a freaking bull in the car.
He does this during parades.
Yes,
he does it during parades. Let's go on a joyride.
And for some reason, he and the bull just decided they wanted to go for a little trip. The news tried to call, this gentleman, Lee Meyer, but he wasn't there. So his wife, Rhonda, got on the phone and told this radio station that Howdy Doody had been Meyer's best friend and buddy ever since he got him 8 or 9 years ago. Rhonda Meyer told US 92 that Lee thinks he's a movie star after his video of his traffic stop went viral, but he's a little shy. Howdy Doody is like a member of the family now, but she wasn't always wild about how much her husband spent on the bull over the years. He bought a former police car, and turned it into a bull shotgun thing.
He was stepping out on Rhonda with the bull.
Yeah, I know. Wow. I just can't even say. It was just, I saw it as a thumbnail, and I was like, oh, I've got to look at this.
How do we even move on to economic and business news from there?
I don't know. There's a whole lot. What's coming out of the other end of the bull is a lot of what I see on Wall Street sometimes.
And in Washington, D.C. too.
And the bulls have been running this week. So I thought it was a good trend to get us into the week here.
It was apropos.
Yes.
I hear you. All right, let's go 2 feet in at this point.
All
and
right.
I know we could probably spend an hour on this because Moody's, Fitch, S&P now, I believe all three have officially downgraded.
You gotta love Moody's. They are right on the ball. Only 2 years later from everybody else.
Well, I still think they're gun shy from the financial crisis and all that other stuff. But apparently, this drew the ire of politicians. Well, no kidding. The first downgrade was 2012. 11 years later, we're now getting another downgrade from another major. So what happened in the last 12 years? They just said nothing to see here.
Yeah.
But I got to tell you, I don't know about you. I have been impressed. I don't have any other word for it, by the market move in the last 3 weeks. And it has just gone parabolic. I think it's a head fake. I said it was a head fake 2 weeks ago. And this negative credit rating that came out, I believe it was over the weekend, last weekend, had mooted effect on the market. And I was talking to another advisor friend of mine, and we were talking about all these things are just cinder blocks stacking up on cracked ice on a pond. And listen, I would know we sound like doomsday here, but how can we just say inflation is down again this week, which is good? How can we say, okay, it's all clear, they're going to start lowering rates in 6 to 9 months, let's start buying stocks again?
Yeah.
I just, look, we all know mentality, thought process about money and investments is very emotional, but the smart people, the smart money are basically in cash now, or cash equivalents. What are your thoughts?
I think I'll share a chart. I just want to show people, because I don't think graphically, when I go to my part, I'll show the Treasury yield curve. And I just don't think people realize how out of whack the Treasury yield curve is at this point. And the chart that I have, I can show like what a normal one looks like and what this one looks like.
And most people will tell you a normal yield curve going from the lower left to right basically is showing you that things are healthy, things are stable, whatever you want to call stable. But yeah, we're not even close to a normal yield curve.
I knew it in the back of my head, but when you look at it actually graphically, you get an idea. And I think the other part is, I think some people, and I've had some conversations this week with clients, and specifically a couple of newer clients, that their whole strategy is, I'm just going to invest in treasuries now. And the problem with that strategy is all the meat is at the short end and that can change drastically. If you're sitting out there at 20 years, okay, let's say you're banking 4.8 right now. Oh yeah, I can get 5.25 or 5.5 or whatever, or 5 on the short end. Yeah, that's great. But that can reverse literally overnight. And now you're stuck with, okay, now where do I reinvest that money? And am I willing to reinvest it out at the 20-year end?
And the other interesting thing is, if you take a look at what the market has done in the last 3 weeks, compared to the 10-year, which is what everybody looks at as the North Star of the economy and the market, it knocked on the door of 5% again. It was 502.
Yeah.
Went all the way down to 445, 448. Now it's back up to 455, 460 again. What I'm trying to say is, if everybody had that kind of strong belief that, hey, we're at the end of the rate hiking. If we're at the end of that and things look great with the economy and inflation is coming down, that 10-year would be under 4 now.
Yeah. But I think that the other part of this, and I think looking at the last 2 years in the Treasury market, in 30 years in this business, I have never seen interest rates move, especially on that longer end of the curve, move as fast in either direction that I've seen. It's insane, because usually the bond market's the most boring place out there, and it's eking out an extra 0.2% here and there on either side of it. You're seeing 100 basis point moves in either direction in really short periods of time. So it's really a crazy time for the safe asset of all things.
Yeah, I know. I think I might have mentioned it before. A year ago, I never bought a treasury. I never bought a bond. Yep. Maybe I got some bond funds, right? That pay dividends because it's more tax advantage. I never bought a bond before. So I got to go out there and really listen to some of the smart bond people. And they are astounded. I can't even get enough adjectives to describe how they feel of the movement in the bond market in the last 24 months.
Yeah.
They said it's not normal, it's not healthy, and it's very dangerous. And there's a lot of reasoning behind it that I don't think I can explain as well as they can. But the idea is, they're saying now a flat curve coming from an inverted curve has almost guaranteed a recession in the next 6 to 9 months. So I think our calls were 3 to 6 months early. You can't predict everything, right? So they're looking at first half of next year, probably Q2 the latest. Now, a recession is gauged differently. You got to listen to the people, because the bond market is where the smart money is.
You would have thought they would feel a little bit differently, or they think they're the smart money, but they would feel a little differently today, I would say, than they have. It's very unpredictable in what should be a very predictable area of the market. I think people are running from, I'm worried about stocks and now I'm going to go into bonds, and it's okay. That's not necessarily, I think, having having balance in your portfolio is a good thing. I was talking to a client who her whole strategy is, or a potential client whose whole strategy is she's just going to stay in treasuries for the rest of her life for retirement. And I was like,
how old is she?
Early 60s. You know,
nothing wrong with that if you could get 5%.
Yeah, it is. Are you going to get 5%? And the problem along those lines is, okay, if you get 5% and inflation's 3.5 net, you're only getting a couple percent. And if you're pulling 4% out of your portfolio, you're going to run out of money. It's just straight up. It's you're just not making enough, even with that.
Yeah. So the last thing I want to do before I went on to the next slide, the other thing a lot of these bond people were talking about, because the average person and the average advisor doesn't pay attention to this, are the bond auctions on a weekly basis.
Yeah.
I believe it's either 3 or 4 weeks in a row they're saying every auction has basically been borderline or atrocious.
Yeah.
Just as far as the demand for it. So that's got to be telling us something too.
Well, it was funny. I think this week's Treasury auction, they actually put up half the amount that they normally would, and it still failed. That's saying people aren't really, the world outside of the United States who usually buys the majority of treasuries are going, it's not really worth it at this point.
Now, I've been riding the coattails of that. There was a great article in Forbes about, again, I know we're a little bit of an echo chamber, but I think some of these things are very important. And I know we don't have like hours to go through all these, but they were talking about how the stars continue to align, which is a great headline, because I think that's all you and I have been talking about over the last 3 to 5 months about how all these stars have been aligning. First one is just earnings expectations, talking about the negative forecast that a lot of these companies and sectors have been identifying. And earnings is the mother's milk of growth in the stock market. If the E in the PE is not either stabilizing or growing, if it's contracting, that's not good. That means the price of the stocks will come down, or the price will go up, but obviously go to an expensive level that it's overpriced. And then at that point, the steeper you're going up, the steeper and quicker the fall.
It's interesting that you've only got effectively 3 industries predicted to have positive earnings there. Yeah.
Obviously, technology, they got a cash machine there that isn't going to go away for a long time. Energy, I believe, I got to tell you, I stopped getting clients involved in the energy side sector, I don't know, 5 years ago. Got burned with a few. I let that lie because I'm starting to get that thing in the back of my neck again. But the problem is it is so pegged to oil. And oil is the most manipulated market in the world. How can you look at, I'm just using it as an example, Exxon, Chevron, Occidental, Marathon, Hess, BP. How can you look at any of these and really say, these are the earnings over the next couple of years, when oil can go from 60 to 90 in a matter of 6 to 8 weeks and back down again? How do you know 6 months or a year?
Well, and you've got basically large cartels controlling that and saying, okay, we're going to cut production because we want to keep prices high or whatever. And you have no control over it. So I typically don't invest a lot of money in anything commodity related or can be heavily regulated by the government, just for the simple fact that I don't have any control there. I at least feel like I have some control over some of the other stuff.
Agreed. And I've always said this to people about oil and precious metals. Everything is about supply and demand. So can you tell me how much gold is in the ground and how much has been mined in history? Can you tell me how much oil is in the ground and how much has been pulled out? No, the answer is no. So if you don't know the supply, the demand to a certain extent, but if you don't know the supply, how can you come up with a reasonable price other than it to be manipulated? My last quick point there is, one of the OPEC people, let's leave it at that, excuse me, basically said, I don't know, this was 6-7 years ago, he was on one of the business channels saying, we think a good price for oil is between 80 to 100. So I have a couple friends and clients we were talking about. I'm thinking to myself, how does he know that? What is he basing? What is he basing on? Now,
we just like that price. It's a good
price. Look at the median price of oil in the last 10 years. 80 to 100. They know their numbers. And that's because their average cost to pull out a gallon of oil out of the ground is under $50. I think it's in the $20 to $30 range. In the US, the average cost to bring out a gallon of oil, I think, is in the 50s, mid 50s. That's a pretty big delta.
Yeah.
So,
yeah, it's amazing. Like I said, and utilities, I've been burned so many times on utilities at this point. I don't want to be there.
With utilities, it's interest rate sensitive.
Yep. And with interest rates all over the fence, it's just, once again, it's an area that I just don't want to play in. I was listening to the news yesterday, and they were interviewing Louis Navellier, who I think is fantastic. And he was talking about market breadth, and he said, he goes, I basically am down to about 6 industries that I'm investing in right now. And he goes, going into next year, I could see that reducing down to maybe 3. Right. And this is one of the best investors in the world, consistently outpaced everybody. And he's talking about how it's getting tighter and tighter to find places that he's comfortable investing in at this point.
And I think if I remember correctly about him and a lot of other very smart investors, they follow the options market. Yeah. They're watching the call and the put volume and the expiration on those to really see where the smart money is putting it, because obviously that's a derivative. And as long as it's kind of a little bit behind the scenes, they're able to stay ahead of the curve.
Mm-hmm.
Absolutely. All right, let's go on. So I thought this was a great chart. I've heard some pretty interesting market strategists talk about job holders. Having the number of job holders having 2 or more jobs is at an all-time high. So what is that telling you? Okay. Yes, they're making more money in one job, but as they make more money in one job, inflation comes up, so they're not really ahead. So they need to put in another 5, 10, 15 plus hours a week to pay the bills or to save a little bit, to have an emergency fund. It's a little scary. I get, hey, I love people that hustle, right? It's better than the lazy people looking for handouts. But I think that's.
I mean, the problem is you run into a point where you have no more hours left to do. There's only so many hours in the day, and you run into a point where if you can't make it with one job and you've got to have a second job, there's only so much time you have at that point.
No, and that's part of the issue, which is just setting something up, and that's part of the issue. It's just like at some point you're going to get burnt out. What do you live in? It's tough. So I have to see how that trend continues. So moving on here, wrapping up some of these other slides.
You dropped them off. There you go. Okay.
Yep. I had a slide out of place here. Yeah. So I think I'm going to go through these next 4 fairly quickly. Okay. So representation of roles and layoffs, recruiters. And I know some people, and I have a client that's a recruiter. She's been pretty safe in her job. But when recruiters get laid off, what is that telling you? Yeah, the demand for talent is falling off. I think that's. I never really thought about that hard until I saw this chart.
Yeah, one of the guys that's in my office here that works out of the co-working spaces I own. He's a Meta recruiter. He got laid off earlier this year, and he was like a senior recruiter, so he was in charge of other recruiters. Had to lay his entire staff off, and then he got fired.
I think that's interesting. Let's keep going here. So just looking at like the personal savings rates, I know we've talked about this before. This is scary because that means people are just spending almost every dime in their pocket. Yeah. We've talked about this before, not so much on the auto delinquencies, but certainly the credit card. And I don't know how anybody could look at these 2 charts going, if the middle or lower middle class and the poverty level people are in so much debt and the auto delinquencies are going up. And again, these are auto delinquencies over 90 days, not just recent delinquencies, and then student loans and keep going down the line. What is this telling you? It just
and especially you look on the credit card we just talked about it last week. They hit 23% average now.
Bumped up again.
Cards. Yeah. So, I mean, now you've charged your cards up to the limit, and now you're getting whacked by 23% every month. That's 23% a year.
Yeah. Yep. And then here's the other one: the new card and requests for limit increase rejection rates. First time I've seen this chart. Obviously, it segues off of what we were just talking about. The credit card rejection rate was at the second highest in record, just after or in the middle of the heart of COVID. And then the second one is people wanting, again, they're at their credit card limits. They need to increase their credit limit, and they're getting rejected. So that means at some point, if the credit card and the banks are saying, sorry, time out. We need you to be an adult again and start doing prudent spending and saving. This is unbelievable. And again, it was circled how unprecedented this is. Again, it's just another cinder block on the cracked ice on a pond.
Well, and you combine that, you go back to that other slide of the amount of people with 2 jobs and more trying to get to full-time or more than full-time. And it's okay, they're having to work harder and they can't get the credit that they have. It's going to have some effect across the board when it comes to retail sales and everything else, which we'll talk about here in a little bit.
Yeah. So I got to tell you, so my last slide very quickly, of course, things aren't getting better about government funded and government related places. But hey, did you know stamps are going up again? They got to try to pay off the $6.5 billion loss for the fiscal year.
Wow.
I don't think raising stamps again, another 2 cents is gonna put a dent into this. And obviously they're just going to keep losing money every single year. I know they're trying to move from gas to electric, which should help bring down that cost, because I understand like the gas line item cost on the P&L is a high single digit, low double digit number as a line item cost on the overall P&L.
You look at the inefficiency of the distribution model. Every single piece of mail is literally delivered by something that is gas powered, and you've got this very inefficient distribution model going out into neighborhoods and everything else. I think the one thing it's been interesting, at least us moving down to Austin, was in the Dallas area where I lived, every house, there were no like group mailboxes in our neighborhood. Everybody had their own individual mailbox. So that postal worker was driving around to every single house and distributing and everything else. And now, there are very few neighborhoods in our area that don't have the one solid mailbox for the neighborhood, where you just come in or you've got multiple ones.
In my neighborhood.
Yeah. I think that's been part of the deal for them to cut costs a little bit, but it's still an inefficient distribution model, taking it out there. And it's interesting. We don't even have the little mail trucks here. They actually use their own personal cars. And I'm guessing they pay them for it, but it's okay. Is it more efficient to own the trucks and distribute, or is it more efficient to pay 65, 70 cents mileage on there?
And if it wasn't for e-commerce, Amazon, eBay, Walmart, if it wasn't for them using the post office to help deliver, what would that loss have been?
Yeah.
Because you remember, a lot of the post office are doing Saturday and Sundays. Yeah. We're getting right into the holiday season, and they're going to be working overtime on the weekend to deliver those packages.
Yeah, but how much of that is employee cost too, and that's built in there? So yes, we've got them working Saturdays and Sundays, full Saturdays and full Sundays. They usually only worked half a Saturday. So now you've got them being paid overtime to distribute that. Are they actually making money on that, or is it just marking time or going backwards? Who knows at this point?
I don't know, but between the post office and Amtrak, basically it's just another social security program for the government to help keep it alive.
Just sucks money in and doesn't really put any money out. Let me quickly bring up my slides here real quick, and we'll just go through these, more of the economic stuff. We've been watching the manufacturing indexes really closely because I think that's a really unique indicator. Philly Fed, once again, was down, but not down as much, interestingly enough, as consensus, and it was outside of the consensus range. So it sucked less than it has been. This one is interesting, though.
I just don't understand how these things are so far out of consensus ranges. It's just, I don't get it.
Now, once again, we've said it multiple times. I want to come back as an economist because you can make money and be wrong all the time. Yeah. This is the one that really was intriguing to me. Empire State, which has been one of the worst throughout the year, and came in at a 9.1 positive. Consensus was -3. It's been negative for going on 18 months now. And all of a sudden it popped up to 9.1. So is it something that was mismeasured? Did they report a wrong number? I have no idea. But this,
I don't know, they should all be fired if they're off that long.
That's like insane. And you can drive a truck through the consensus range as it is, and they can't even hit it in.
Why even give a range at that point? We'll find out when you do.
Just guess. CPI this week. I think this was some interesting things. We'll look at CPI and PPI. I think very intriguing to me to start seeing the effects of, I think part of this is the interest rates, but I think part of it too is the bond market. The bond market has been doing a lot of the work of the Fed this year. And we're starting to see, okay, we're pulling back on CPI. Inflation's coming back a bit. I think the other part that people need to look at, though, is you're still inflating above really inflated things. So people still feel the effects of this because we had some 9% in there, and those prices aren't coming down. We're not seeing deflation. We're still seeing inflation on top of very inflated things from a couple of years ago.
Yeah.
At this point. PPI, same thing. Actually, the first negative PPI number. So this was intriguing to me. I don't know your thoughts on it.
This is what I don't get. They were expecting positive. It was negative.
Yeah.
So that means prices are coming down.
Yeah.
So prices are coming down. That helps with inflation. A lot of people are expecting a spike going into the end of the year. It should be interesting to see what the consensus was and how much it is out of range for next month, or for this month, reported next month. But all this is telling you, if you look at what's X, there was no month-over-month change, X food and energy. Year over year, it's still going up.
Yeah.
So, and again, we already talked about energy and the pricing of energy. So I think not that it's disturbing, but it's just following the trend that prices are still going up. Whether it's reflected in the CPI or not, prices are still going up.
Yeah. Yeah. And like I said, on top of very inflated prices as it is, so it's not making people's lives any better. It may make Wall Street feel a little bit better. I think starting to see a little bit of crack. This is back to your piling cinder blocks onto cracking ice. We saw a retail sales go down. And this was one of the things that spiked the market this week, because it was like, oh my God, it didn't suck as bad as we thought it did. But the reality is, okay, retail sales going into Christmas season are declining. What does that mean? Are those people maxed out on their credit cards? We don't have a traditional season anymore. It seems like now all these internet retailers are doing Black Friday in the middle of October or whatever, trying to get ahead of everybody else instead of the traditional Christmas season. But if you're already seeing these cracks in the ice in October, what's November and December going to look like?
If you look at sector charts, the retail sector has been sucking wind over the last several weeks, number one. Even though it had a nice bump in the last couple of weeks, a lot of I know Target was out talking about profitability because they're securing a lot of their items in glass right now because of all the stealing, but he still said that the consumer's been slowing spending.
Yeah.
And Walmart is at an all-time high, but even they've seen pullback with consumer. So crazy.
Yeah. I feel really good about being an investor in Walmart because I've got a 75-year-old person at the front door stopping people from leaving. Last one, jobless claims. So this one's been hovering down in the consensus, so I really hadn't shared it much. But this week, it spiked up significantly and out of consensus range. So you're starting to see more and more jobless claims. Now, this was something I still have to go back and do a little bit of research with to find out, okay, do the striking worker, these are jobless claims, but did the striking workers, did that have some effect on these numbers? But I would assume it's probably not, because you quit, you didn't get fired or laid off.
But also remember, they were getting subsidized by the union fund while they were on strike. So I don't think you could do that and get an unemployment check.
Yeah. So this tells me that things are starting to ramp up. If this continues, things are starting to ramp up on the jobless claim side. More and more layoffs happening. A lot of it's happened in the tech sector. People got shuffled around in that sector a little bit from what I've seen. But it's starting, I think, to roll out into some of the other parts of the world here.
I agree.
Some of the other industries.
Yeah, remember, the unemployment hit 3.9. It was as low as 3.4. And people, I think if it hits 4 or 5, don't forget too, seasonally, a lot of the major layoff announcements usually come in the first couple of weeks of January.
Yeah, because that's when they come out of their seasonal stuff in retail and everything else. Plus you're rolling into a new year and they're trying to pretty up their balance sheets and everything. But yeah, I think we'll see more of that. And once again, it's all along the lines of a lot of the things we're looking at. Yeah, is the Fed, do they have enough dry powder to keep us afloat and have their soft landing that they're talking about? I don't really know at this point.
And a lot of people are talking about decrease in the rates. The only way that would happen is if something does break in the economy. Yeah. Things do slow down too much, right? And if things slow down too much, that means somebody's not making money, right? And that's going to affect the markets, and it's that trickle effect. So if and people were talking about as early as March again. Remember we were talking about, remember how they were talking about November, December? Then it was like those are the same people talking March, but the consensus, the first rate cut is May, June, or July of next year.
Yeah. And once again, the Fed doesn't really like to be making moves during a presidential election year, because it gets looked at as you're manipulating the market so that whoever's in power can stay in power or whatever.
Hey, listen,
they tend to,
they sat on their hands for probably 12 months too long.
Yep.
So I don't think they're going to sit on their hands, because next year, I think if they do anything, I still think there's going to be one more rate hike, 1/4 point. I thought might have been November, maybe it's December. They're talking, no, you'll kill things. So maybe it'll be January. That'll be the last rate hike. And maybe that's the one to say, that's the one to push things to a snail's pace. Maybe it'll be a soft landing. Who knows? But I still think there's one more rate hike.
Yeah, I personally don't think there's going to be another one. I think we're done at this point, but I also don't think that we're going to see anything remotely come down anytime soon. I think if you look at the Treasury yield curve, that was one thing I promised before we got out of here. Let me just quickly pull that up here, because I wanted to show kind of what normal and what not normal looks like. All right, here's what the yield curve looks like today. Right. So you've got high rates on the short end and low rates on the long end. Now the 20-year has started to come up a little bit. So this is what it looks like today. Let's go back to 2010. That's what a normal yield curve looks like. Yep. And even if you look back to 2020, that's what a normal yield curve looks like. This is what we have today. So there's a lot of feel good in this for people that are very conservative, that, yeah, I'm going to make all this money, but that can come unglued pretty quickly. And you need to understand that this is where the market is settling at right now, is that 4.9-ish, 4.85, somewhere around there on the 20-year. And it's very likely that's where it'll settle down. So you need to be planning ahead for that eventual kind of shift around on the short end to get back to normal.
Yeah. Listen, this is a great chart because we've been talking about it for several months now.
Yeah.
And this is what happens typically 9 to 12, sometimes 18 months before a major slowdown or a recession in the economy. And then when it starts to flatten, go back to before it goes normal again, that's when usually the economy steps in a pothole.
Yeah, and that's where the Fed will start to pull rates down, but they only really control the short end. The bond market controls the longer end. And it, like I said, 20-year is settling in 4.85, somewhere in that range. And that's probably going to be where the top end of the curve is eventually at some point. So you've really got to plan ahead for that. At this point, you got to plan ahead for the fact that there's probably not going to be very much movement. People think, oh, rates go down, my price of bonds is going to go up, so I want to be out there on the long end of the curve. If it's already there, it's very unlikely you're going to get any kind of movement on it.
And these volatile bond rates are not good for banks.
No.
Because their risk management becomes an impossibility.
Absolutely. And you're sitting there, 4 or 5 something right now on the 10-year, which is what they use to judge most of their stuff.
Yeah. We'll have to see. Next week is Thanksgiving.
Yep. So we'll be on Thanksgiving. So we won't do a show next week, but we'll see you guys back here the week after. So thanks a lot. Make sure that you check on that little subscription button and give us an upvote so we know you're out there, and share a comment if you like what you hear or if you want to hear something different. So we'll see you guys back here the next time.